great to see you.
Hi, Pamela. It's great to be back.
We're delighted to have you here. You wrote some great notes, and everyone circulated them, and they came back to you, and someone said, hey, you should read this, it's great. And actually, it was yours.
I will.
I think that's great. So let's go there. This is talking exactly about how tariffs work their way through the economy and ultimately sort of what they mean. What do you mean disinflationary? What have we got? What would tariffs do to make things disinflationary? This is in the US.
Yeah, look, there's a debate among economists in terms of what tariffs might mean as it relates to inflation. And I think there's two sides to the argument. One is, hey, look, prices are going up. You hold all else equal, and that means inflation rises. But the shocking thing to me is when you look back in history, I mean, you can go all the way back to the 30s with Smoot-Hawley. We had tariffs in the 70s. We had tariffs in the 80s. We had some tariffs in the early aughts, right? And we have our 2018 experience. In each of those experiences, and of course, they're all very different, and we're talking about something very different from a size perspective. But in each of those instances, over the next year, the CPI or the PCE deflator, any of your inflation gauges, decelerated, not accelerated. So to me, this is a very big flag waving in front of all our faces and saying, well, maybe it leads to some price increases, but it doesn't lead to a generalized rise in the overall price level. And I think the reason is, and there are some economists, and I sort of side with them, that this more often than not acts like a tax to the US consumers, meaning if the price of washing machines goes up via tariff, well, if somebody doesn't give you more money to buy more goods, then if you have to buy a washing machine that's 60% more expensive, then you sort of outlay your cash for that. But demand is destroyed in other areas, and those prices actually decelerate. So said differently, there's a really big offset that's traditionally seen. Again, we don't know in terms of the scope and size that we're talking about in terms of tariffs, but it more is a purchasing shock to the US consumer. And I think when you look at it that way, that's the best frame of history to think about tariffs, is that how big would it be? How much of a shock to income would it be to scale it? And how much of a tipping point would that be for the US consumer or the overall market? And we can examine it in this context. If you think about, the tariffs, whether it's Canada, Mexico, or China, we can think about what they are in terms of that hit. It could be, not all of it is felt for the US consumer. Some of it might be felt by the foreign producer. They don't think that the marginal propensity to consume is high enough in whoever they're selling to, that maybe they lower prices a little. And there's also what we learned in 2018, the offset of currency.
This is the Whirlpool example, isn't it? This is the China Whirlpool washing machine example.
That's exactly right. So what you can find is that if the US currency appreciates, then the US consumer is held stable in terms of their own currency terms, and the foreign producer is held stable in their own currency terms. So not all of tariffs actually hit the US consumer as a shock, really only a third. And when you look at, if we said that it was going according to plan with Mexico, Canada, Canadian oil, and then the Chinese tariffs all hitting at the same time and staying, and if only a third of that hits the US consumer, that's actually less than a 50 basis point headwind to income, which isn't to say it's completely insignificant, but we can look at those shocks through history because more often than not, we've got it not via tariffs, right? Tariffs have not been a thing that we have had to assess in this market for, as long as I've been investing. But we have seen shocks like this in oil, and we have seen shocks like this in rates. So we can examine it in that context and say, is this 50 basis point hit significant as it relates to consumption? It usually is, in the sense that you see consumption slow, right? Growth is slower, but it usually doesn't negate it entirely. And then when you look at the market reaction to that 50 basis point headwind, you actually see it's de minimis. It gives you the same odds of market advance. It gives you the same average returns, meaning that it's not enough, usually, statistically speaking, to be an offset for whatever the core driver is to the market, which is usually earnings growth.
So if tariffs is going to be like the word, I think de minimis is going to be the dictionary word of this year. It's fascinating. So, I mean, like with other research that you will provide on certain things to assess shocks, is in the US, it can be absorbed, is really sort of how you're looking at this. It won't be great, but people will have offsets. They'll transfer. I think you had an example too of buying fresh fruits, veg, so on from Mexico. Maybe you'd switch what you ate basically. It's absorbable.
Substitution effect. It's hard. You might end up with a grumpy consumer, but to the extent that you always bought Mexican avocados versus California avocados that are more expensive, if now Mexican avocados are as expensive as California avocados, maybe you only buy 2 avocados a week versus 5, or maybe you just stop buying avocados. So your purchasing power can be kept intact, but you might be a little bit grumpy about it. But your purchasing power is kept intact and your sort of real wages are as well. Now, that's not true as we translate from avocados to, say, steel, right, where it's a very inelastic demand, right, where you have very elastic demand of avocados. Like, if it's too expensive, I'm just not going to buy it. That's not true across the spectrum, which is why sometimes it hits, sometimes it doesn't. So that pass-through is sort of diluted. And I think what we risk is, which is not to say that there's no level of tariffs that won't be a big enough shock. There are, but it's much higher than you think. It would take something like 25% across the board tariffs on the $3.2 trillion of imports that the US has to be a over 1% shock to the US consumer. That's a tipping point that you need to start to worry about. Statistically speaking, when you look back in history, most of the US recessions have seen a shock between 1.5% and 2.5%. So that was back in the 70s when oil prices were a much bigger threat to the economy. So that's not to say that tariffs won't be a headwind, but it is to say that if it ends up sort of getting dragged out, and it's Mexico and Canada today, but then not tomorrow, and China maybe ad infinitum, and then we'll be talking about Europe, and some exceptions get made, and some tariffs roll off, and some new ones roll on. All of a sudden, that time that it takes to implement the tariffs gets dragged out to the US consumer as income is growing. So look, I think one of the things that we need to consider is that this is, from a frame of reference perspective, we can think of it potentially as a lot like 2004, 5, 6, and 7 as it relates to oil prices, where we always thought higher oil prices was going to break the US consumer. It went from 40 to 50 to 60 to 70. And everybody said, when is the consumer going to break with these higher oil prices? And what turned out to be the case was, well, you could grow into it as incomes grow over time, which is what we usually say, which is growth is a lot more important than whatever variables that we're worried about if you have time on your side.
Okay, fascinating. Because you mentioned oil, let's go there and sort of go to the discussion which you will often bring up, which is spare capacity. We're looking at what Canada exports to the United States right now. It's the type of oil that ultimately works at the refineries. Doesn't mean everything couldn't have been switched around, but for sort of the purposes of looking at the tariff oil story, again, there's an absorption story here of what can be absorbed by US consumers. Can you take us there a little bit just to give us a sense of what will be tolerated?
Right. I mean, it's interesting when you think about US demand specifically, and when you look at it, as much as global oil demand is fine, there's nothing wrong with global oil demand, it's growing at 1%. The US, in terms of overall oil demand, has never really recovered, meaning that it's been flatlined. So as much as there is, we're worried about the incremental supply hit based on tariffs, right? Higher costs for our refineries. Will we pass that through to US consumers? Will we import less? Will we refactor the refineries? What all that means is, in some ways, yeah, maybe that is an excess capacity hit, but you're having a problem with demand on a sustainable basis. So because demand in the US specifically, again, this is overall and not global, hasn't really recovered nearly as robustly as you would think, maybe excess capacity needs to be crimped. In some ways, I'm less afraid of excess capacity coming out of the system for overall energy prices because the starting point is so high. If the market wasn't saying, hey, you've got a lot of excess capacity out there already, then oil prices probably wouldn't be $70. Right. And so I think that just the fact that, maybe there is some incremental supply that potentially comes out might not be a great thing for the stocks just because your starting point is already so egregious.
That is absolutely fascinating. Tell us a little bit about some of the players that are running the ship out of the new administration. We've certainly heard lots of confirmation. I listened to some of them in their entirety, and some of them I find too long to listen to. But certainly Scott Bessent, the new Treasury Secretary, confirmed and then made some comments yesterday, which just kind of clarified the whole story of tariffs, which was they're a means to an end. We're using them ultimately to help us make the tax cuts that we need to make. There's going to be a great big tax rise if we don't have some other revenue coming in, and this is how we're going to do it. We kind of knew all that. Just for your thoughts on the new players, the messaging, how it's delivered, what do you think?
It's interesting. The bond market was very, I would say, happy that Secretary of the Treasury actually got confirmed. And it was mainly on the back that he was more of an incrementalist, or we thought the market thinks that he's more of an incrementalist as it relates to tariffs. So a little bit the adult in the room as it relates to that. From my vantage point, I think what's interesting about the regime shift is that you finally have somebody with a capital markets background in the Treasury. Rather than an academic background. And I think that that's, so anybody who's interested in sort of the detail around that, follow Barry Knapp on Substack, Ironsides Macro. He's written a lot about that. So we, I think, drifted from an area where people who bought and sold bonds were actually on the Treasury and on the Federal Reserve, to now we're disproportionately more exposed to people in academia. And not a whole lot of people in the administration has bought or sold a bond. So if you haven't done that, if you don't have a capital markets background, you might not understand fully the consequences. So I do think that having somebody with a capital markets background does provide, I think, a more stable footing as it relates to capital market strategy from the Treasury going forward.
That's absolutely fascinating. Another one that's been rolling through the confirmation testimony and so on is on the healthcare front. It does look like aspects of the healthcare system in the United States really are ready for complete reform. Can you talk a little bit about that? There's RFK, and that's sort of who we're talking about at the lead, but I guess there's a broader team as well.
There is a broader team, and it's actually two people I follow mainly for the last 4 years based on their data-driven approaches. So Mockery and Jay Bhattacharya are the two sort of individuals underneath, whether or not RFK finally gets confirmed, but I think it looks like that will be the case. But I think that the lower level players do have a strong scientific background that have been very, very data-driven over the course of their careers. And I think that you're right. If we think about where the disruption needs to happen, as uncomfortable as it is, when you look at the disproportionate spending in U.S. healthcare, I think that is an area for gain. When we think about whether or not spending should be more targeted, or how we should spend it, or how the targets should be met in terms of U.S. healthcare. So I do think that that's something to watch. Having people, especially at those lower level positioned, just like I talked about capital market strategy in terms of the Secretary of Treasury, data-driven approaches as it relates to the underlying people who run the healthcare subsectors, I think is important as well.
Really interesting. To financials, which is one of the sectors that you've talked about a lot with us. I'm interested in your sort of ranking of it, but also just to talk a little bit about how it fits into a broadening within the stock market, really, but within the economy as well. In a lower rate environment, there are other things going on, but it does look like there could finally sort of be that NIM story for financials.
Yes. No, it does start to seem like everything is pointing in at least a different direction. Whether or not you say it's a strong direction relative to what we saw, pre-financial crisis, I think we can still debate. But you have seen a turn in earnings growth, right? You still do have very supportive valuation. You have lower interest rates and lower credit spreads, and I think the two of those is very important. And your starting point is on very wide valuation spreads, meaning, look, there are a lot of people who are still fearful of small and mid cap banks, and they've bid up the safety measures in those large cap banks. And I think once you see that valuation spread, that says to me that there's opportunity. So we've got 4 statistical factors that I think put financials in a really positive bucket as we look into 2025. And they could, not only just keep up with the market, but potentially be leadership as we talk about this broadening out trade of, what's next in terms of technology. In the Mag 7 might have carried us thus far, but what carries us the next 12 to 18 months? And I do think financials are in play just because the risk reward is so positive that I see in the data. And it's funny that you mentioned financials. I was just working on my note for tomorrow, which if you follow me on LinkedIn, you'll get it the week after. So you'll get last week's note this week. But I was just looking at the inflection in loan growth to your point of, maybe there's finally a NIM story. So what we've seen now, especially after the election, in terms of sort of business optimism, you are starting to see almost a top quartile inflection in loan growth, which is fairly rare, right? So obviously it only happens 25% of the time. That's usually a good thing for the overall market in terms of the durability of earnings growth, but it usually does lead to outperformance in financials as well. So it's not just that the setup is good. I think we're finally still starting to see confirmation in things like loan growth, which is tangible as it relates to earnings.
I mean, we spoke a lot about the Mag 7 almost just not even feeling an interest rate story over the course of the last 3 years, right? It was just totally immune. They didn't need to borrow. They had free cash flow to do absolutely anything they wanted to do and to do CapEx to the moon, which they did. But on their own terms, nothing related really to the interest rate story and borrowing. Now there are other players that actually will be able to borrow to grow, and which goes to sort of what you're talking about with financials. Just tell us a little bit about smaller caps, basically, or mid caps at least, coming down the cap spectrum from those who actually do need to borrow to grow.
Yes, in some ways, like as much as we say that we didn't see an official recession in 2022, and we didn't. We obviously didn't have two back-to-back declines of GDP, nor did we see the type of contraction that we saw in COVID or the financial crisis. But we did see a contraction in small cap earnings, and we did see a contraction in small cap job growth. So in some ways, the recession that didn't occur was really all on the backs of small and mid-cap lenders and small and mid-cap businesses. And I think that that was partly a function of the recalibration or the renormalization from COVID, but also partly a function of QT and the way it's been done to date. And we'll see if this new Secretary of Treasury takes it a little bit differently. But this in terms of QT, selling the bonds that they bought during QE, they have disproportionately sold bills, shorter term instruments, versus bonds, longer term instruments. And in part, it was probably, and they didn't ask my opinion, and I don't exactly know why they did it, to keep long-term treasury rates a little lower when we were worried about that crimping the overall economy. So that kept large businesses who borrow at long duration for long duration assets and in the broader credit market sort of in good stead. But for those small and mid-cap banks that lend at lower rates, and for those small and mid-cap businesses that borrow at shorter term interest rates, it disproportionately affected them. Right. So that's what we've seen really play out this cycle, is as much as it wasn't a true official recession, we've seen a massive shift in terms of the balance of the economy shifted towards beneficial for those large cap businesses and away from those smaller cap businesses. We're starting to see that unwind. And it might even be true that over the course of the next year that QT doesn't pursue the bills sale strategy and disproportionately starts to sell longer duration assets. That rebalancing, along with the loan growth that we're seeing, might actually be quite beneficial for both small and mid-cap lenders and borrowers. And that might finally lead to that broadening out story that we've been talking about.
Come on,
where equal-weighted earnings growth can finally keep up with cap-weighted earnings growth.
I mean, I feel like we're burying the lead. Like, that is just incredible if you think about it. And it loops back ultimately to probably to Scott Bessent, ultimately. I mean, you're certainly looking at the policy and which levers they're going to pull. The QT story is something that, in a way, we've ignored for quite a long time. Maybe we didn't need to pay attention, but maybe we do now.
Yes. Yeah, it's very nuanced. It's a very nuanced story. Because if you look at it on the whole level, like QT isn't usually a bad thing for the overall market, right? The withdrawal of accommodation usually is a result of the fact that there is growth, which is the issue this time. Just like QE, like we saw in the financial crisis, isn't the ultimate salve, because if you're doing QE, usually you have no growth. Always growth is the most important factor to the market.
Is there I mean, I guess there's always a situation in which you would see QE come back, but just as it relates to the budget, what's trying to be tackled in terms of the deficit story, is there ever going to be a case for that in the near term, or what would have to go wrong for that to happen?
For QE again, you would have to be flirting with deflation again, which is, look, it's always a possibility. I mean, you know that I think that a little bit of inflation is not a bad thing for economies or markets, right? The sweet spot for the market returns is 3 to 4% inflation, which is pretty much where we are, depending on sort of how you calculate it. I start to get more nervous the more inflation decelerates, because those deflationary crises are a little more risky, in my opinion, I should say, based on the data, than those inflationary crises that we just lived through. They tend to be a little bit more short-lived, and earnings growth going down, let's call it 5 to 10%, is a lot different than earnings growth going down by 25 to 50%, which is what we have seen in deflationary crises. So it's a different response by businesses. It's a different response in the overall economy. So to the extent that we ever get back to QE, I think that that is sort of the dangerous zone. Now, it's just an open question of there will be a cycle, right? So at some point we will have another recession, although Australia has gone this long without one. I think 20, 25 years. We're working on. So I guess anything is possible, but at some point there will be another recession. And I think that we need to think about the stickiness to inflation being a good thing and being protective in that circumstance.
So let's sort of roll this back into, well, you were talking about the equity market and what type of inflation is in fact pretty good actually for growth there. Right. Is there an exuberance story that could be attached to that, good or bad? I mean, there's upside risk as well as the downside risk, but we're talking about something that's disinflationary, but there is also sort of an exuberance story out there.
Yes. So it depends on the way you think about exuberance. So for me, like, I'm a relative investor and I worry about downside risk just as much as I worry about melt up risk, right? Because I think that those are two real things, right? I've been bearish and right, bearish and wrong, bullish and right, bullish and wrong. The most I've ever lost on a relative basis was being bearish and wrong. So the market can run you over in that circumstance. And I think so it's important that I assess risk on that basis as well. Now, a lot of people will say, well, the market's already exuberant. You look at some sentiment indicators. Certainly, if you were looking at them, especially 6 weeks, 8 weeks ago, you would see them at top quartile levels and say, point to that fact that, well, everybody knows Denise's soft landing is ensued, like it's all priced in. The quantitative measures that I think are much more predictive than those sentiment indicators that reset quite rapidly all are pointing to the fact that the market is quite fearful. Right? Valuation spreads are still wide. You can measure monetary policy uncertainty. It's at top quartile uncertainty levels. Economic policy uncertainty is at top quartile levels. Trade policy uncertainty is at top quartile levels. And you can measure this and you can look monotonically. The more uncertainty there is, the wider expression of fear there is, the wider those valuation spreads are, the more likely the market is to climb the wall of worry. It's quite linear from that perspective. So I don't really see a lot of exuberance. I understand people are pointing to the fact that the market's gone up more than 20% over the last 2 years. But when you look at that quantitatively, that's not enough to sort of de-risk your equity portfolio just because the equity portfolio has been good. In fact, those 20% years that we've seen back to back, if you look in through history going back to the 30s, you'll see the next year following is usually above average as well. I think you got to go back and assess the core driver, which is earnings growth. And so much of what I'm looking at right now points to that durable earnings growth that I think is just still smoldering in the background of, equal weighted is finally joining cap weighted. We've got a more diffuse earnings recovery, but without being sort of that hockey stick V-shaped recovery, which can decelerate quickly. This looks very durable, and the more durable earnings growth looks, the more the market looks through any valuation that you have right now through that durable earnings growth and usually gives you above average returns.
So that would look through the immediate tariff story as well, perhaps on both sides of the border. To what extent could we be optimistic that, as goes the US economy right now, even with this threat of tariffs that we're sort of living through, that the Canadian economy will be dragged along with, either a melt up, maybe not a melt up, but, success in the US markets?
Yes, I think that that's a good, bet from a corollary perspective. I mean, certainly true. I mean, Canada and Mexico. When the US sneezes, they catch a cold disproportionately. And that fact works to the opposite side as well. The more durable the GDP is, and the more durable even earnings growth is in the US, which is ultimately the driver of our economic cycle, the more likely it is that both Mexico and Canada actually have higher GDP growth. I mean, you wouldn't say, I want to bet on it every year, but you would say, yes, on average, that actually is a positive thing. And it's a positive thing for the global economy as well.
Absolutely. Okay, one question here. I'll just put you, this is rolling in here. This is thoughts on the surge in the dollar. I'm going to assume that's the US dollar because that's usually what the dollar means, and how it impacts sectors.
Yeah, not as much as you would think. I know people have asked me for years to build a sector rotation portfolio based on the dollar, and I get the theory, right? So you would want to own these sectors because they're export heavy or import heavy, and it just isn't consistent enough. So as much as you want to say that you need to, sell energy in a stronger dollar environment, it's just not consistent enough to bet on. And I think what it shows you is that starting points matter. Where are your valuation spreads? Where's your relative valuation? And earnings growth is more durable and has bigger drivers than just currency. So no, I don't use the dollar as much in my sector allocation, I think is a lot of, as most investors ask me.
Okay, and we will ask you bottom three. Go for it.
Yeah, so top three: financials, consumer discretionary, still technology. I like software within technology. And I'd say bottom three, I'm going to put utilities as number one, just because they outperformed a little last year. And I think that that's the most negative risk reward. And I'll still put energy as number two. And then I would put consumer staples as number three.
Okay. Denise Chisholm, we are always better for seeing you. Thank you very much for joining us here today on Fidelity Connects.